Welcome to Flow Tao Salon. The iridescence of the 2021 consumer bubble has faded, leaving a core of companies built on technical necessity, not marketing spend. We are analyzing the 2025 China Pet Industry Tech Innovation and Investment Report, released this March 2026 by the Pet Industry Tech Innovation and Investment Forum and Pet Nebula. The data shows a striking divergence. Total capital invested in 2025 hit a 5-year low of 900 million RMB, yet investment events surged to 40. This gap indicates the 2021 to 2024 era of reckless scaling has cleared out, leaving smaller, frequent transactions. We have entered an era where capital is highly cautious with its check sizes, but active in placing early-stage, deep tech bets. In 2025, venture capital began a structural withdrawal from the massive, traffic-focused rounds that defined the previous decade. The average deal size has fallen to 22.5 million RMB. This drop proves that the market is no longer subsidizing high-burn user acquisition. This chart confirms the transition. Over 60% of all 2025 funding rounds were concentrated in seed, angel, and pre-A stages. Investors are now spreading risk across specialized niches. They are looking for technical validation rather than betting on a single consumer brand to monopolize the market. For founders, the path to funding now requires proving a technological moat at the seed stage, as the capital for growth at any cost has disappeared. This new focus on technical moats has split the industry into two different capitalization realities: the food oligopoly and the medicine incubator. Pet food remains the primary capital sink, absorbing 425.5 million RMB, nearly half of the entire industry's funding. However, that capital is concentrated in a few massive late-stage blocks. These rounds are almost exclusively tied to regional supply chain dominance in the Luoyang and Yangtze regions. Without this underlying infrastructure, early-stage retail brands struggle, as seen in the total closure of the heavily funded Pets Fresh. The medicine sector operates on a different logic. While the total height of this pillar is only 203 million RMB, it is divided into 14 distinct deals, representing the highest transaction volume in the industry. This velocity is driven by the technical hurdles of biopharmaceuticals. Because these products have long R&D cycles, investors must enter at the earliest stages to secure a position. This creates a clear strategic choice. Food is an arena for scaling existing supply chains, while medicine is the primary engine for incubating new startups. These macroeconomic trends provide a specific set of rules for any founder attempting to raise capital in 2026. Consumer brands or platforms without vertical integration face a hostile environment. Due diligence now centers almost entirely on technological depth. The report highlights the specific moats currently attracting capital. This includes AI and IoT integration for proactive health management and precision nutrition for customized C2M production. These startups are winning because they focus on active health tracking and breaking foreign monopolies in hardware diagnostics. In 2025, a startup's valuation is tied to the complexity of its proprietary systems, not the breadth of its user base. The industry has moved past the clearing cycle of the last 4 years. It is now defined by technical hurdles and proprietary infrastructure rather than simple consumer goods. The data reveals 3 conclusions. First, the capital pivot. Tech-driven validation replaces marketing scale. Second, sector polarization, a strict split between food supply chains and medicine incubators. Third, the moat. Valuation demands hard tech and compliance. Burning capital is obsolete. Flow Tao Salon, wishing you a prosperous year of the horse.
陶醉沙龙，马年行龙。